So you invested in a mutual fund thinking it was the smart, safe choice. But what if I told you there's a good chance it's quietly eating away at your wealth without you even realizing it? I used to work at a bank and as an investment wholesaler, dealing with mutual funds every day. I've seen all the little marketing tricks, things like convoluted fees, complicated reporting, and just enough jargon to keep you confused. By the end of this video, you'll know the 5 key signs that your mutual fund is holding you back, and more importantly, I'll show you some more transparent ways to grow and protect your wealth. Sign number 1, your mutual fund underperforms the benchmark. Many investors assume that as long as your mutual fund is making money, they're on the right track. But what if your fund is making far less than the overall market? If your investments are underperforming their benchmarks, you're actually losing out on potential wealth, even if your balance is growing. Earning 10% in 1 year might sound great, but if the benchmark is returning 20, that doesn't sound as good. So how to check performance? Every mutual fund should be compared against its relevant benchmark, like the S&P TSX Composite Index for Canadian equity funds, or the S&P 500 for US equity large cap funds. Every mutual fund you buy will have its benchmark listed. One of the easiest ways to evaluate the performance of a mutual fund is by checking Morningstar. Simply search your fund name on Google plus Morningstar, and you'll get a detailed breakdown of its historical returns, quartile rankings, and comparisons to its category and benchmark index. Let's do an example here. So looking at the Morningstar performance breakdown for Scotia Selected Balanced Growth Portfolio, Series A, it's immediately clear that this fund has underperformed its benchmark over time. At first glance, this growth of $10,000 chart tells us the full story. The index growth has reached $18,814, while its category growth has hit $17,079, while Scotia's Selected Balanced Growth Portfolio only has $16,458. So despite its massive $4 billion of assets under management, this fund has not delivered strong returns to its investors. Consistently poor performance and weak returns. This fund has struggled against both its category peers and benchmark over multiple timeframes. In 2024, for example, it's in the 4th quartile, which is the bottom 25% of its category. And its 3-year and 5-year rankings, it's in the 3rd quartile, signaling consistent underperformance. For its 10-year ranking, it's also in the 3rd quartile, proving that long-term investors have not really been rewarded. Its trailing returns confirms this underperformance. For 1 year, it returned about 8.62%. For the index, it returned 11.42%, and the category, it returned almost 11%. For the 3 years annualized, it returned just shy of 5%, where the index returned 7%. And for the 5-year annualized, it returned just about 5.14%, and the index returned 6.6%. And the 10-year annualized, it's 4.6%, where the index returned 6.01% per year. Over a decade, it has trailed the index by 1.41% per year, which means an investor with $100,000 in this fund missed out on potentially tens of thousands of dollars in potential gains, all while paying higher fees for subpar results. Remember, even if you're making money, you might be missing out still. A common investor mistake is focusing only on the positive returns. But if your fund grew by 3% in a year where the market grew by 10%, you effectively lost 7% in missed gains. How serious is this problem? Well, the SPIVA Canada Mid-Year 2024 report confirms that most actively managed funds in Canada underperform their benchmarks over time. The longer you hold onto an underperforming fund, the bigger that performance gap becomes. 2/3 of Canadian equity funds underperformed their benchmarks in just the first half of 2024. And over 10 years, that number jumps to a staggering 93.4%, meaning only 6% of actively managed Canadian equity funds actually beat their benchmark over a decade. That to me is quite shocking and a very clear indicator of how big this problem is. Sign number 2, high fees that eat away at your returns. Banks count on you not noticing fees because they make billions of dollars from them. Many mutual fund investors underestimate how much fees eat into their returns. Even if a fund performs well, excessive fees can cripple your long-term growth. A 2% annual fee might seem small, but over 30 years, it can reduce your final investment value by over 50%, costing you hundreds of thousands of dollars. Here's an example, the hidden cost of a 2% fee. Let's say you invest $100,000 in a fund that earns a 7% annual return. With no fees after 30 years, your investment grows to $761,000. But with a 2% annual fee, your investment grows to only $432,000. That's a difference of nearly $330,000 lost to fees. In other words, in this case, 2% of fees wiped out 43% of your potential gains. So let's break down these fees a bit more. Mutual fund fees that destroy wealth. MER, or management expense ratio. Anything over around 1.6% for equity funds and 0.75% for bond funds is considered pretty high. In contrast, most index ETFs charge only 0.05 to 0.25%, meaning mutual funds can be 30 times higher in fees. Then you have your hidden trailer fees. Many mutual funds pay commissions, usually 1% to advisors, incentivizing them to sell high fee funds instead of what's best for you. It's important to understand all the fees, which is why we are very transparent here at Blueprint about our all-in fees with our investment partners. Then you also have your high trading fees or your turnover ratio. Some mutual funds frequently buy and sell stocks, incurring very high trading costs that could get passed on to you. Some red flags and fees to be aware of is if your advisor won't explain the fees clearly. If your advisor dodges questions or makes the fee structure sound confusing, they probably benefit from those fees. There's also high redemption fees if you leave in some cases. Some mutual funds penalize you for switching out to another investment. Another is if you might actually be owning a segregated fund. Some insurance companies sell segregated funds that look and feel like mutual funds, but they come with extremely high fees, often 3 to 4%, and insurance features that most investors don't need. And how to tell if it's a seg fund is if it's held with an insurance company like, say, Sun Life, Manulife, or Canada Life, or if it includes words like segregated or guaranteed benefits. It also has higher fees than even mutual funds, often exceeding 3%, or if it has a maturity period, for example, 10 years. Sign number 3, your fund is too risky and keeps you up at night. Investing should help you build wealth and peace of mind, not leave you stressed and anxious. If market drops make you lose sleep, constantly checking your portfolio, or panic about your financial future, your mutual fund might be too risky for you. And here are some signs you have too much risk is if you feel very stressed out when the markets decline, if a dip in the stock market causes you to worry, sell investments impulsively, or lose confidence in your financial plan, your portfolio may not be aligned with your risk tolerance. Another sign is if you react emotionally to market news. Taking on too much risk can lead to panic selling, which locks in losses and prevents you from benefiting from market recoveries. Also, if you don't fully understand what's in your fund, some mutual funds hold very volatile assets or have complex strategies that aren't transparent to investors. If you don't know how risky your investments are, you could be in for a very unpleasant surprise. Your investment timeline doesn't match your fund's risk. If you need access to your money in the next few years but hold high-risk equity funds, you may face large short-term losses that derail your financial goals. One often overlooked aspect of risk is what I call your mental wealth. Even if a risky investment performs well over time, it's not worth it if it affects your ability to think clearly and stay the course. So how to fix this is to recalibrate your risk exposure. A balanced portfolio should reflect your financial goals, time horizon, and ability to handle volatility. Take an investor questionnaire. Free tools from firms like Vanguard can help you assess your risk tolerance and adjust your portfolio accordingly. Consider more stable investments. If your mutual fund is too aggressive, switching to a diversified, say, ETF portfolio or a lower volatility fund can help you sleep better at night. Before you go on, understanding your risk tolerance is just one piece of the puzzle. If you're not tracking your net worth yet, you could be missing out on key insights into your financial progress. Download my free net worth tracker for Canadians. It's a simple way to stay on top of your finances and make better investment decisions. Get it now for free. I dropped a link in the description. Sign number 4, your mutual fund is a closet indexer. Closet indexing is one of the biggest ripoffs in the mutual fund industry. It happens when a mutual fund pretends to be actively managed but closely tracks an index while charging the high fees of an actively managed fund. Investors are led to believe that they're paying for expert decision making, but in reality, they're just paying more for the same thing they could have just gotten from a cheap ETF. Here's an example is a TD Canadian Equity Fund, which to me is a classic closet indexer. This fund is a $7.4 billion fund that markets itself as an actively managed fund, but its performance and holdings closely tracked the S&P TSX Composite Index, all while charging a very high MER of 2.19%. Why this fund falls short? Well, first of all, it underperforms the index. Over 10 years, this fund returned 6.87% annually, while the index returned 8.59%. It also has very excessive fees. The 2.19% MER significantly eats into returns compared to a low-cost Canadian index ETF like XIC at 0.06%. It also has a low active share, and what that means, it has a low turnover rate at 12%, which means the fund isn't really making bold investment decisions and buying or selling a lot, yet it charges a very high fee. So how much are you losing? Over 10 years, the fund trailed the index by 1.72% per year. An investor with $100,000 in this fund missed out on over $20,000 in potential gains, all while paying steep management fees. This fund is a perfect example of closet indexing, charging for active management while delivering index-like returns. Closet indexing is kind of like paying for a 5-star chef at a Michelin restaurant, but getting a frozen TV dinner instead. Shockingly, Canada has a poor track record with closet indexing. According to a research report, approximately 37% of assets in Canadian equity mutual funds are invested in closet indexers. A Morningstar study also found that many actively managed mutual funds in Canada have low active share scores, meaning that they barely deviate from their benchmarks. Closet indexers won't admit that they're just expensive index funds, so here's how to identify them. First of all, compare the fund's holdings to a benchmark ETF. If the stock allocations look nearly identical, you're paying high fees for no added value. I broke this down in another video of mine called the TFSA Wealth Killers, where I compared the RBC Equity Fund to VFV Vanguard Index ETF, so check that out. Look at the long-term returns. If the fund's performance moves in lockstep with an index but charges higher fees, it's highly likely it's a closet indexer. You can also check the turnover rate. A low turnover rate under 20% suggests the fund is barely trading, meaning it's not really making a lot of real active decisions, yet you're paying high active management fees. Consider tracking error. If a fund's returns closely match the index year over year, it's likely a closet indexer in disguise. Sign number 5, tax inefficiencies that cost you thousands. Even if your mutual fund performs well, tax inefficiencies can silently drain your returns. Many investors unknowingly pay more taxes than necessary because their mutual funds trigger avoidable tax consequences. So here are some tax traps that are hidden in mutual funds. The first are distributions that trigger unnecessary taxes. Many mutual funds distribute capital gains, dividends, and interest income. If you hold them in a taxable account, you might owe taxes even if you didn't sell anything. This means that even if the fund lost money, you could still get hit with a tax bill. Holding high dividend funds in a taxable account. Dividend paying mutual funds can be tax inefficient outside of a TFSA or RSP. And while Canadian dividends receive a dividend tax credit, US and international dividends are usually taxed at your full marginal rate, leading to unnecessary tax drag. And how to reduce taxes on your investments? First of all, use the right accounts, keep dividend heavy or income generating funds in RSPs or TFSAs, and use taxable accounts for tax efficient ETFs or capital growth investments. Consider switching to ETFs. Many mutual funds distribute capital gains frequently, while broad market ETFs can be a bit more tax efficient. Rebalance wisely. Selling funds can trigger capital gains tax, so be strategic about when and how you make changes. Alternatives to mutual funds. If you're holding high fee, underperforming mutual funds, it's time to explore better alternatives. Before I get to that, I want to point out the psychological trap that might be keeping you stuck. Many investors hold on to bad investments because of loyalty to their bank or advisor. They might think, well, I've been with this bank forever, they must be looking out for me. Or my advisor says this fund is great, so it must be. Another is, I don't want to switch, it's just too much hassle. But here's the reality check. Your financial future and your family's well-being should always come first, not loyalty to a bank or advisor or the minor inconvenience of switching funds. If your investments aren't serving you, it's time to be more demanding about your needs and having a transparent strategy that actually helps you build wealth. So here are some other investment options that are more transparent with potentially lower fees. So the first thing that you might want to look at is to simply switch from your Series A fund to a Series F fund if you're not getting real advice. What I mean by that is a Series A fund is the one that your bank sold you. Usually includes hidden advisor fees, meaning your free advice is actually paid for by high commissions baked into the fund. F funds, on the other hand, is a lower cost version of the same fund without embedded advisor commissions. You could get access to these Series F funds usually only through, say, a discount brokerage, so you'll have to sign up for that and figure that out. If your advisor isn't providing real financial planning, consider switching to a low-cost ETF portfolio, robo-advisor, or fee-only financial planner who actually puts your interests first. Then you have your ETFs, which have much lower MERs, starting at 0.05% fees. It gets you much better tax efficiency and often outperforms mutual funds due to its long-term lower fee approach. Then you have your low-fee mutual funds. A few actively managed funds exist with reasonable MERs, but they're quite rare in Canada. There's DIY stock investing. For those willing to manage their own portfolio, investing directly in individual stocks and ETFs can be a much lower cost alternative. You also have robo-advisors, which are automated investment platforms like Wealthsimple, which provide diversified ETF portfolios at a fraction of the cost. And finally, here's an approach I've been having success with lately, are portfolio managers. For those who want active management, working with professional portfolio managers can provide customized strategies with all-in fees ranging from 0.5 to 1.4%, depending on your portfolio size, and it often comes with financial planning services. Most mutual funds aren't built to make you rich, they're built to make the banks rich. But you don't have to settle for underperformance, high fees, and poor transparency. If you want a smarter way to invest, visit our website and see how we can help Canadians take control of their money with better strategies. Check out our services, download our free investment tools, and start making your money work for you, not just your advisor. Please hit like, subscribe, and let's build your wealth the right way.